Right now, there is a company on this planet worth $1.83 trillion, more than the entire economy of most countries on Earth, and yet the people who run it, the insiders, own less than 1/3 of 1% of it. Let that sink in for a second. If this business is so valuable, why do the very people building it hold almost none of it? Stick around because by the end of this video, that question is going to make a lot more sense, and you're going to see some numbers that most casual investors completely overlook. We're talking about Taiwan Semiconductor Manufacturing Company, or TSMC, the company that quietly builds the chips powering almost everything with a processor in it. Let's start with the size of this business. TSMC's market cap, which is simply the total value of all its shares combined, sits at $1.83 trillion. Its enterprise value, which adds in debt and subtracts cash to show what it would actually cost to buy the whole company outright, is $1.76 trillion. Notice that enterprise value is actually lower than market cap here. That's a small but telling detail because it usually means a company is sitting on more cash than debt. And TSMC is sitting on a lot of cash. $110.58 billion of it against just $30.88 billion in debt. That's a net cash position of $79.7 billion. In simple terms, this company could pay off every dollar it owes and still have tens of billions left over. But here's where things get interesting, because a pile of cash alone doesn't tell you if a business is actually healthy. For that, we need to look at how efficiently it turns sales into profit. And this is where TSMC starts to separate itself. Revenue over the last 12 months was $139.57 billion, and net income, the actual profit left after all expenses, was $69.68 billion. That means TSMC kept almost 50 cents of every single dollar it brought in, a profit margin of 49.92%. To put that in perspective, most companies are thrilled with margins in the teens or 20s. TSMC is nearly at 50. Gross margin, which measures profit before operating costs, is even higher at 64.23%. At first glance, that sounds impressive, but the real question is, what's driving numbers this strong? This is where investors often get confused, assuming high margins simply mean a company charges high prices. The truth is usually about efficiency, and TSMC's efficiency numbers are almost unusual for a company this size. Look at revenue per employee, $1.54 million generated by each person on the staff, and profit per employee sitting at $769,439. With about 90,557 employees total, that's an enormous amount of output per person for a manufacturing business. Now here's a number that tends to surprise people. The return on invested capital, or ROIC, which measures how much profit the company generates for every dollar it invests back into itself, is 54.61%. Compare that to the weighted average cost of capital, or WACC, which is basically the minimum return a company needs just to justify using that capital in the first place, sitting at 10.94%. When a company's return is roughly 5 times higher than its cost of capital, that's not a small edge. That's a business creating real value with almost every dollar it touches. But does that mean there's nothing to worry about? Not exactly. Let's talk about valuation because this is where the story gets a little more complicated. The trailing price to earnings ratio, or PE ratio, which tells you how much investors are paying for each dollar of past profit, sits at 26.30. But the forward PE, based on expected future earnings, drops to 18.49. That's a meaningful gap, and it suggests the market expects earnings to grow substantially from here since the price looks cheaper once you account for future profits. And that lines up with analyst forecasts, which call for revenue growth of 30.10% and earnings per share growth of 35.75% over the next 3 years, based on a consensus rating of strong buy from 19 analysts with an average price target of $520.37. That's 30.63% that above where the stock sits today. Sounds exciting, right? But here's something that doesn't get talked about enough. The stock has already climbed 67.69% over the past 52 weeks. That's a massive move. Yet the relative strength index, a momentum indicator that generally signals a stock as overbought above 70 and oversold below 30, currently sits at 39.11. In other words, despite that huge year of gains, momentum right now is neutral, even leaning soft. That's the kind of contradiction that trips people up. A stock can be up enormously over a year while showing very little short-term excitement in the charts today. And that's not even the most surprising part. Short interest, the number of shares investors have bet against, is only 0.57% of shares outstanding, with a short ratio of 1.91 days to cover. That's an extremely small amount of pessimism baked into this stock, which tells you skepticism, see right now, is minimal. Now let's talk about financial safety, because this is where TSMC starts to look almost overbuilt for caution. The current ratio, which compares short-term assets to short-term liabilities, is 2.46, meaning the company has well over double what it needs to cover near-term obligations. Debt to equity is just 0.15, remarkably low leverage. And then there's interest coverage, a measure of how many times over a company could pay its interest expenses from operating profit. TSMC's number here is 201.44. Not 2 times, not 20 times, over 200 times. That is an almost absurd cushion against financial trouble. Add in an Altman Z-score of 11.47, a formula designed to flag bankruptcy risk where anything above roughly 3 is considered safe, and a Piotrowski F-score of 8 out of a possible 9, which grades overall financial health and quality, and you start to see a company that scores near the top of almost every stability measure available. So where's the catch? Well, free cash flow, the actual cash left over after the business pays for its own operations and equipment, was $35.28 billion. That sounds like a lot until you compare it to capital expenditures of negative $46.87 billion, the money spent building and upgrading its massive chip factories. TSMC is spending enormous sums to expand capacity, and the price-to-free cash flow ratio of 51.94 is notably higher than its trailing P of 26.30. That gap matters because it means investors are currently paying a much steeper price relative to actual cash generated than they are relative to accounting profits. This is where investors often get confused, assuming profit and cash flow always move together. Here, they clearly don't, largely because of how much is being poured back into growth. And finally, there's the dividend, often overlooked in a story this focused on growth. TSMC pays $2.76 per share annually, a yield of 0.69%, small on the surface. But dividend growth year over year was 29.91%, with 3 consecutive years of increases and a payout ratio of just 20.55%, meaning the company is only distributing a small slice of its profit as dividends, leaving plenty of room to keep raising it or keep reinvesting. So what do we actually have here? A company with extraordinary profitability, a fortress-like balance sheet, almost no leverage risk, and analyst expectations pointing toward strong future growth. But also a stock that has already run up sharply, trades at a steep premium on a cash flow basis, and is pouring tens of billions into future expansion that hasn't fully paid off yet. Strength and risk, sitting side by side in the same set of numbers. The real question worth sitting with isn't whether these numbers look good today. It's whether the massive capital spending happening right now turns into the next leg of growth analysts are expecting, or whether the market has already priced in a future that still has to prove itself. What do you think that answer looks like a year from now?